Well, good morning and thank you for joining the Ellerston Global and Morphic Funds webinar. My name is Lisa Rose and I'm the Head of Intermediary Sales at Ellerston Capital. Today we're joined by Bill Pridham, who's the Portfolio Manager for Ellerston and Morphic's Global Equity Strategies. In today's presentation, Bill will detail some portfolio stocks in focus, outline macro considerations influencing portfolio positioning, and provide an update on performance for May. I'm sure many of you will have questions for Bill, and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Bill to start the presentation.
Terrific. Thanks, Lisa. Thanks for the introduction. I think we're getting a good rhythm here in terms of the webinars. We've been doing it for several months now. And it feels to me like it's kind of coming into this type of rhythm in terms of we touch on reporting season when that's timely. We're doing some deep dives on positions that we own, and we have webinars on more market and macro considerations as well. So those three themes seem to be the cadence of what we've been doing. But if you have any other feedback or thoughts on more that you'd like to hear about or from, please let us know and we can adjust accordingly. But it feels like that's the way it's progressing so far. So this one's more about stocks, a bit of a deep dive into a couple of stocks that we own. We did PTC a couple webinars ago. Today we're going to do two, not as in-depth on each of them, but a good overview of what they are. As Lisa mentioned, we'll talk about some positioning considerations, where we're currently set up in terms of the fund, and finally wrap up on performance. So with that, let's hop into the stocks in focus. So the first one is actually one of our biggest positions. It's a company called Sensata, and as you can see, it's been around for quite a while. The big thing that is, though, it's only really been in the last decade or so, it's really come into its own in terms of, secular growth drivers. And that's coming from, regulations, typically around safety, around efficiency, and more recently around climate concerns around vehicles globally. So Sensata provides highly specialized mission-critical sensors, primarily to the automotive and heavy vehicle off-road sectors. And to put it in context, roughly 60% of the business is exposed to the global automotive market and about 40% in heavy vehicles and industrial applications as well. So the old saying goes, you can't manage what you can't measure. And what Sensata does, it provides those mission-critical sensors which provide that measurement capabilities for customers. So it's really driven by four major mega trends. They've been kind enough to highlight this for us, so it makes my job a little bit easier to describe them. But currently the bread and butter of the business is the first one, the clean and efficient. So it's all about regulations at the end of the day. It could be emission regulations. We're seeing China 6 emission controls coming in. We're seeing California emissions coming up as well. So that's you need those sensors to really drive to measure those emissions. Some of braking safety is another one as well. Also, it could be high voltage contactors in cars from a safety perspective in terms of shocks as well. That's been a real big driver over the last decade from the business. More recently, we're seeing a lot more legislation around tire pressure management systems. So in your car, if you're driving along, you see that little pressure come up in your car, but one of your cars might be under pressure. That's probably one of their sensors in there providing that. But what we're seeing now is the global on-road truck fleet. We're seeing a lot more legislation come in. And from a tire pressure management system, by 2022, all trucks in the U.S. have to have this system in place. So I guess that kind of gives you a flavor of the drivers underneath that first part of the bucket. Second one is electrification. We're going to touch on that one in the next slide, so I'll jump over that one for now. Then we have the autonomy side of things. Really, that's more about your heavy vehicle trucks, your self-driving mining trucks and the like. Clearly, we'll have passenger vehicles, the sharing economy come through as well, but I feel that's more of a really long-term opportunity for the business. And finally, smart and connected. So it's all about asset management in real time. So when you think about the global truck fleets that are out there, they need to measure the tire pressure on the trailers and the tractors as well, refrigeration levels, the temperatures, utilization of the fleet, where is the fleet as well, and you need these sensors in place to do that. Sensata's been pretty aggressively been moving into the sector over the past year and a half or so. They bought a business a few months ago called Zergo, which really leapfrogs them into that opportunity. So what it does, it combines their sensors on the truck with a dashboard, so the fleet manager can watch this in real time and manage the fleet effectively. So that's a real long-term opportunity. That they expect that to be a $15 billion addressable market over the next several years as well. So when you think about it, you look at this business from a clean safety point of view, regulations driving it, but we have these three other big megatrends driving the business longer term. I'm just going to touch on the near-term one right now, which is electrification. So electrification means so much more than just vehicles for Sensata. You know, you think about the charging stations. There's a massive shift to come on in terms of building all the charging stations if we're going to have an electric vehicle fleet. You think of the smart grid. You need to have sensors in terms of connecting all these charging stations and renewables as well. Storage applications. There's many, many different applications that require sensors, and from a Sensata point of view, because they're mission critical and operate in harsh environments, they're really well placed to participate in this. But what I'm going to focus on this slide is more on the electric vehicle side of things, because it is really the near-term opportunity for the business. And the main takeaway here is when you compare an electric vehicle versus an internal combustion vehicle, the content is roughly twice. So you think of the battery thermal management, you think of the braking systems that's required, the addressable market increases quite dramatically. Now, with that, it's great to have that, but are you being designed in? And in a recent conference call, management stated that they're actually being designed into all current EV that have been announced and all future design wins in terms of future EVs put in place as well in terms of the global OEMs. So they are becoming the leader in the electric vehicle space. And with that, you get that corollary benefit of the charging side of things and the smart grid as well. So it really sets them up nicely from that perspective. And like I mentioned, the beauty is that you get more content per vehicle with an electric car. And it's roughly a 20% increase per vehicle compared to an internal combustion car. So you can see this long-term opportunity trend. As the global fleet shifts to electric vehicles, you're going to get that content per car increasing. And I think we're going to see quite pronounced growth in this area. You know, when you're looking at what's happening globally, a lot of countries and states are putting in legislation about electric vehicles or zero-emission cars. So as an example, California has said by 2035, all passenger cars and trucks that are sold must be zero emission. We're seeing similar announcements in New Jersey. We're seeing similar ones across the EU. They're a leader in this space, and even Asia as well. So you're seeing the governments really get behind these zero emissions. And secondly, what's really interesting, we're seeing a lot of new companies being formed to participate in this market. A lot of the smaller companies coming in terms of developing electric cars, electric vehicles, and capabilities and charging as well. But also when you think about the global OEMs, the established incumbents, they're becoming incredibly aggressive in terms of rolling out their EV initiatives. So for us, we don't care who wins in this space. What I like to be is agnostic to technology, and the more of these cars that are being announced and rolled out, the better, because that increases the addressable market and the TAM for a company like Sensata, who is the leader in the space and being designed in to all these new iterations of cars coming through. So it's a good setup for the company. Now, just to put Sensata into a little bit more context, so it's about an $8.9 billion market cap. It's relatively undergeared, and it generates just over $500 million of free cash per year as well. Now, the beauty of its model is that it typically outgrows its end markets by a factor. So when you look at the automotive market, it typically, historically, it has outgrown the auto market by 4 to 6%. But over the last 5 quarters, it's been growing 9% ahead of the end market. And talking with the company recently, they feel there's the potential they may increase that 4 to 6%, just because they're seeing more content per vehicle come through. Heavy vehicles, similar in terms of the content growth, typically grows 7 to 9% ahead of its end market. Again, over the last several quarters, it's been growing 9% plus, so above that top end of the range. So what this basically means, if the auto market's flat one year or heavy vehicles flat for the year, this business will still grow high single digit, even though their end markets are flat. And it's really as a function of regulations and the shift to electric vehicles driving more content per vehicle on these global fleets. So as more vehicles become connected and electrified, the opportunity is that the trend actually accelerates from here. And I think the company's starting to accept that as well and may look to increase their end market growth guide at the end of the day. And when you consider, like last year, the auto market was down 20% during the pandemic. Heavy vehicle off-road has been actually difficult since 2018, but last year was down about 18%. You can see that the end markets are set up pretty well over the next couple of years to really drive growth. So you combine the end market starting to pick up now. You combine the business growing recently been 9% above the end markets. Let's call it the 4 to 6. You can see how this business can grow low double digit over the next couple of years. Clearly, the auto market is being held back by supply chip shortages in the market today. But a glass half full point of view, you can say that it could actually elongate the cycle as long as demand stays robust for the business. So that's the beauty of the model in terms of their outgrowth over a long term. So with that, we expect mid-teens earnings growth over the next several years. Free cash flow will expand at a similar rate as well. And when you think about what we've talked about those mega trends. We've talked about the electrification opportunity. Autonomous is further down the path, but that's clearly a long-term trend. And the smart and connected fleet management opportunity as well. This business trades at 13.5 times PE, generating a lot of cash. So we see some considerable upside here with Sensata, and hopefully it's one of those ones we can hold on to for a very long period of time as a core holding. We're coming up on close to 2 years now of ownership, and the business is just getting stronger through all this, and the valuation is getting cheaper even from the first time we owned it. So with that, I wanted to shift to the next stock, which is Option Care Health. So we had a question on Option Care a couple webinars ago because it was relatively new in the portfolio, and the question was, do you mind talking through it a little bit more? So I wanted to take this opportunity to do a bit more of a deeper dive into it, what they are and what they do, where they're positioned at. We're coming up on about a year, close to a year now. We bought it in July last year, so it's almost a year of ownership. Basically, what it is in a nutshell is at-home care, we feel, is the disruptive business model opportunity compared to the hospital setting. If you remember, we have owned Amedisys in the past. We don't own it today, but it's one that's on our radar. But it's a company that does at-home care from a hospice perspective and once you leave a hospital as well. Option Care is exactly the same style of business in terms of infusion care at home. So infusion care at home or any type of administration of services at home is generally much cheaper than in a hospital, firstly. Secondly, the patient benefits as well because it's much more convenient for them. But more importantly, the risk of infections going into a hospital is dramatically decreased by having that at home. So Option Care is the largest independent provider of home infusion services. So it's licensed across all 50 states. It has around 96% coverage of the U.S. Just under 3,000 nurses or clinicians that are providing this at-home care. And all the top payers are providing them business or have relationships with Option Care as well. So with that broad coverage, it provides a great opportunity for them to expand capabilities. And from a payer perspective, that nationwide exposure means a one-stop shop for them, and they want that one-stop shop at the end of the day. Now, the business operates really in two main areas of the at-home infusion. One's acute and one's chronic. Just to put that in easy terms, acute, you just get out of the hospital and you need to have anti-inflammatory infusions or immunoglobulin anti-infection infusions as well. So they'll come to your home and give you that service instead of you having to go to the hospital. So that's a very much short-term type of service. And then you have the acute. Now, acute's roughly 60% of the business. And when you think of the chronic side is 60% of the business. And we think of chronic, it's a longer-term type of needs or requirements for their services. So it could be for quite a long period of time, or it could be for life. A couple examples could be muscular dystrophy infusions. It could be chronic inflammation infusions, that type of at-home care, which is a very long-term need for the patient. And you want to do that in the best environment for them as well. And we do feel that the at-home environment is the best opportunity for them. So let's put it into a little bit of context about the size of the opportunity here. So the total infusion market is roughly $100 billion, a large market. Roughly 13% of that has shifted to the at-home environment. So it's fairly early days in terms of the shift. With that, it provides a great opportunity over a long period of time, because typically what you see every year, you get so much of that 100 billion move into the at-home care market. And you can see 5 to 7% growth just from that shift alone over a very long period of time. I feel that we're in the early stages of this shift, and the beauty is, with Option Care as the largest independent player, they will benefit from that shift. Right now, they roughly, well, this year they'll have roughly about $3 billion of revenues coming through from this. And as the largest player in this, we're seeing quite a big share shift happening as well. So even though the industry will grow at that 5 to 7, the opportunity is they can grow over and above that as they take market share, and payers give them more of the business as well. And if you look at the right-hand side of the chart here, or the slide, the cost benefit is indisputable. There's roughly 30 to 70% savings when you're doing at-home service for a lot of these drugs. From a payer perspective, they're focused on their costs, and they want to find the best care for their patients, clearly, or the customers, but they're also focused on their cost line as well. So you can understand why it's shifting out of the hospital into the home. Cost benefits and patient benefits is just basically a win-win for the whole system at the end of the day. Now, to put Option Care into a bit more context, remembering, we get this 100 billion TAM shifting to at home, which is roughly 13 billion market today. It's a 3.7 billion market cap company. It's just under 3 times levered, and that leverage comes from a business they bought in August, a year and a half ago. It was BioScrip, which was the second largest player. They combined them together, and they basically now have the largest independent share in the market. Generates good free cash flow. As I mentioned, it's really benefiting from increased payer utilization. So payers want a national footprint. They want to have a national account, and Option Care is really the only player out there from an independent point of view that can do that. And also therapies. So you get new therapies being introduced from an infusion point of view. Just increases the addressable market for them in terms of that at-home delivery model. Now, about a week and a half ago, Biogen announced a new Alzheimer's drug. And interestingly, this drug can only be administered through infusion. So Option Care had a nice little pop on the back of that. I think this could be a long-term opportunity for them. It's multi-billion-dollar potential drug for them. And as the largest player in the home infusion, clearly they'll benefit from that. I'd also think it opens up new markets for them. So Medicare Advantage and new reimbursement schemes may come to market for them to help grow that addressable market, especially in the Alzheimer's category for them. So I think it's not just that drug, it's more new addressable markets opening up for them as well. Just on the last call, they started to embark on some nicely creative M&A. Really, it's about bolting in regions that they may be underweight, or therapies where they may not have the line of sight to. They bought a small business in the Southeast just last quarter. When they buy them, they fold them into their existing infrastructure, buy them at high single-digit multiples, and with synergies, you take that down to mid-single-digit. So it's very creative to us as shareholders in terms of them doing that. In talking with them, I think you're going to see a lot more of that come through. And like I say, it's nicely accretive for the business, and it really drives that arbitrage of the multiple coming to the public market. So when you think about this business, they expect high single-digit revenue growth. The algorithm is that with leverage through their model, they get mid-teens earnings growth through this. The beauty is that high single-digit revenue growth is really a function of that migration from the hospital to the home. So you can see that shift happening for the foreseeable future. And with that, you get that leverage coming through from an earnings perspective as well. So despite, it's done well for us. It's still one of our larger positions. Even with that, we see strong double-digit compounding from here. And with that, it still trades at a 5-point discount to the likes of Amedisys. I view Option Care as good, if not potentially even better than Amedisys, and that 5-point discount to me doesn't make a lot of sense. I think it has to do with the market cap size of it, but we believe over time that spread will narrow, and we see some good upside from this company over the longer term. Now, we'll shift to positioning considerations. And when you talk about positioning considerations today, really, we're going to just talk about inflation at the end of the day. That's the main topic du jour, and that's really a function of what we're seeing recently. So we're seeing inflation print some of its highest levels in decades. Really driven by the explosion in lumber prices, chemicals, steel, freight, used car prices. All those things are driving near-term inflation metrics. And when you think about it, we've had a lot of pent-up consumer demand. There's still roughly, $2 trillion estimated in terms of pent-up demand over in the U.S. And we're going to have future demand from government stimulus starting to feed through. When you think about it, the child payments really start in July. That's $600 a month for a family. So that's going to really start to kick in going forward as well. So that pent-up demand is really not going away anytime soon, especially when you consider the infrastructure stimulus coming through. So we're going to see a lot of demand come through. But when you look at the bottom part of that chart there, the inventory levels have not been able to keep up. They're at record lows across many industries. And there's a real disconnect between, the level of revenues and the level of inventories in many industries. And automotive, similar type of story. They're just running on very low levels of inventory days in terms of cars. And it's just a function of we've had supply shut down through the pandemic. We've talked about this before. And then demand comes in much stronger than expected. Consumer and government balance sheets are really driving this. And we didn't have to go through that repair period, which is typical of a recession. So right now we're seeing a lot of these growth aspects come through. And the thing is, when you look at that disconnect of revenue or sales versus inventories, that inventory needs to be replenished at some point. And when you think about it, a lot of companies might even look to overcompensate for it because they don't want to go through this inventory situation again. So as those inventories get replenished, we could see some very strong growth over the next few quarters. So this is actually coming from Chairman Powell in his last presentation. He said economic indicators continue to strengthen and GDP will deliver the fastest growth in decades as the supply chains are rebuilt. Now, that needs to be done. And the trouble is they're trying to rebuild the supply chains, yet demand is so strong. They're just having a difficult time catching up, especially with the chip shortages that are in the market today. So we can see a situation where, these demand situations continue to be there. Supply is still constrained, and you have this strong period of economic growth coming through as well, which will drive this inflation level. Now, the big thing is to focus on not just the prints that we're seeing today, it's about inflation expectations. So right now they're anchored around that 2%, which is where the Fed wants it to be. And that's a key thing to watch. If that flips up, that would be a concern. But right now, the expectations is what the Fed wants to watch and maintain around that 2%. Now, the big thing is the question is it transitory or is it sustained? I'm leaning to transitory. We're having a cyclical rebound in inflation, but that transitory will shift over time. We still have those longer-term anchors on inflation, which are debt, demographics, and technology pushing back on inflation. But it doesn't mean you can't have cyclical increases. And I think we're seeing that now. If you think of what we're cycling now, we're cycling that really weak period of the pandemic impact of last year, so you have a base effect. And also you have a lot of cyclical impacts as well, like we talked about the lumber, we talked about car prices. Chairman Powell said the last print, 1/3 of that CPI increase was from used car prices. So we'll cycle those as well. So the question is, will there be other aspects come through from an inflationary standpoint? Right now, like I said, I'm leaning to the transitory, but I believe that we're going to have higher levels for a little bit longer because that supply chain still needs to be rebuilt, and it's going to take some time. Now, what would change my mind on that transitory would be two things mainly. Firstly, we touched on the inflation expectations. If that started to really ramp, that would be a concern because it kind of begets itself. When you expect more inflation, you generally get it. And secondly, the bigger one is wages. If you see wage growth inflation really start to pick up, that could be your next level, and that would be something to watch for as well. We're not seeing that today, but those are the main things that I'm watching from a risk perspective as well. So just shifting to our positioning, look, not a lot has changed since our last call. Still much levered to companies in terms of levered to economic growth, improving economy, quality companies trading at great multiples with longer-term secular trends in place. Not a big deal to talk about in terms of changes there. Interestingly, since the inflation print and in Chairman Powell's speech, it's interestingly the 10 years have come down quite a bit since then, and the regional banks have underperformed quite materially over that period. Now, I think that's a function of a couple points. One is those 10-year rates coming down. Secondly, there's a conference at Morgan Stanley where loan growth is still difficult. But again, they're all talking more the second half. But the interesting thing with these regional banks, when you think about them, roughly 80 to 90% of their book is commercial and industrial lending. If you believe that the economy is going to pick up or continue to grow like we do, they're delta 1 to that. Comerica and Bank United trade about 12 times PE. Webster Bank, a bit more of a special situation. They bought a business or did a merger of equals with another bank in Northeast U.S. called Sterling. It trades at 10 times PE. So we've taken advantage of this little bit of weakness and bought more Webster. You'll see it in the top 10 next month. At 10 times, and the synergies coming through from this acquisition, it just makes great sense to buy more of it. Now, if you believe that economic growth is going to slow down from here, the 10-year coming down makes sense. But our view is that economic growth is going to continue to grow, and real rates will tend to increase through that period. And I'm not calling where the 10-year goes, but I think at these levels, probably more closer to the bottom than top on that. Like I mentioned, no big changes to the portfolio, very much levered to economic growth, very much about the great value plays in the market with structural growth behind them as well. And finally, just capping off on performance. So finishing off on May, year to date, we're up just under 34%. But the big thing to take away from that is because we're unhedged, roughly a 13% impact from the stronger Aussie dollar. This month we benefited a little bit from that, but year to date it's roughly a 13% impact. So when you back that out, the stock selection has delivered around, 47% growth in terms of our capital, which has been pleasing. Long term, a little over 4 years now in terms of the fund, and we're comping just over 17.5%, which is all comparing nicely compared to the market. And on the right-hand side, comparing well to the peer group as well. So very happy with that. And knock on wood, we can continue the progress there. And I really think it comes down to just keeping it simple. At the end of the day, we're looking at buying quality businesses operating in global markets with secular growth behind them at attractive multiples. And at the end of the day, if you have that conviction around it in a concentrated portfolio like ours, you should be able to get that, the upside downside capture in place, and holding these positions through periods like March last year and adding to them when you have periods of weakness like we've had over the last couple of weeks as well. It's about the conviction around those positions at the end of the day, and that gives you that upside downside capture, which drives that previous chart at the end of the day. I just want to also touch on the Morphic Global Opportunities Fund, which is also unlisted. So I took over Morphic Global Opportunities and MEC, which is a listed investment company, in October last year. So they're all mirrors of each other now. Every position is the same. So consider them all one when I talk about them. So going forward, you'll see all the performance numbers pretty close at the end of the day. Just touching on MEC specifically, last NTA was at 145.5. Share price is 121.5, and it's got 30 cents of dividend profit reserve in place as well. So it's set up nicely from an opportunity point of view. Because when we look at the portfolio, they're all mirrors of each other, and we see some great upside in a lot of the names that we've talked about and other ones we haven't talked about as well. So just a summary of the top 10 holdings and the geographic allocation. And with that, I'll switch to Lisa for some Q&A. Oh, sorry, just before we do that, Lisa, can I just go through to the appendix here? What we're doing now, and I don't think many do this, is provide, in the barbell you see all of our positions, but this will give you, and I really like these, the presentation here in terms of this is every company we own. And it just gives a snapshot of what they are. And I think if you know me, you know that I want to provide as much transparency as possible in terms of what we own. all of us own as shareholders. So when you go through periods of weakness, you can be confident that these businesses are strong businesses and operate in great secular growth opportunities. So this is every company we have and a snapshot of each one as well. So I just wanted to point that out. Sorry, Lisa, that I popped in that. So maybe we can shift to Q&A now.
Thank you, Bill. No need to apologise. We've got a question for you, which I'll ask. So participants, if there are any additional ones, please do feel free to send them through. Bill, the question is, we've seen a number of these names within your portfolio for some time. What's your turnover been like, and what should we typically expect?
Yeah, it's a tough question to answer for this year, Lise, because we've gone through. Let's do both of them. So let's do the Ellerston. So it used to be EGI, used to be a listed company. If you remember, in August last year, we converted that into the trust. So you had a fair bit of turnover from. You had tax implications around that. You had different shareholders benefiting from the migration towards NTA, which took profits as well. So you had a lot of turnover this year from that perspective. So it's kind of an abnormal year from an absolute perspective. From the Morphic fund side of things, as I took them over in October, I shifted them more to the Ellerston mid-small strategy. So there's a bit more turnover from that perspective. So let's take this year as a bit abnormal. And clearly we had the pandemic as well. So there's a lot of shifts coming through. If you think September last year, I shifted into the regional bank. So this has been quite an abnormal year in terms of asset allocation and corporate impacts as well. If I'm going to take a step back, we've owned companies for years. Think of Cellnex, we've owned it for over 3 years. QTS, which you'll see there, just got bid for by private equity. I've owned that for over 12 years in private life in this one. So I like to own these businesses and compound with them for a very long period of time. So when I think of turnover, think of names versus dollar value. So dollar value will be higher than names. And the reason is this. So when a stock gets to fair value and it's a big percentage of the fund, I'll bring that back down. So I want to trim and add these positions based on their relative risk reward. So turnover on an absolute basis will be higher than the level of names. Names turnover will be fairly low. There will be periods where I'll add more, like I did with the regional banks, and I shifted more into the industrials last year. But I like to own compounders that will stay in the positions in the portfolio for quite a long period of time. So let's do it in a perfect world. Name turnover might be 30 or 40% over a year. In terms of percentage of capital, will be higher because I'm trimming and adding around those names. So I hope that answers the question around that.
Thanks, Bill. We've got a great question that's come through. Given the current cycle, can you make further comment on the two companies that have been for some time in your high growth category? So Bill, that's your LiveRamp and LivePerson. Yep. How are they performing and contributing?
Yep. So a bit of tale of two cities there. So it's interesting with LivePerson itself. So it basically is hooking up your favorite brands with your favorite form of messaging. So let's say you're Virgin Australia and you want to text them and you want to do that through Facebook or through WhatsApp. They provide that connection and do that on a global scale. So that's what they are. They are winning business leaps and bounds at the end of the day. They're growing faster. The beauty with the business is actually accelerating on itself. They just announced a deal with Adobe last week to provide the messaging services for Adobe in terms of their consumer brands as well. So that business is roughly 3% position today. Quite happy with that level of investment in terms of LivePerson, growing strongly, now generating profits, and getting a lot of the new deals come through. So very happy with that one. LiveRamp has been a little bit more difficult. So it's come off. If you remember, we've talked about, I think it was last webinar, we talked about those high growth names coming down from February to today. And LiveRamp has been caught up in that a little bit. So it's come down to around $41, $42. But interestingly, the business has never performed better. So it's benefiting from privacy. Google is shutting off cookies, and that makes it very hard for advertising companies to track you and me as we go through the internet and across our different devices. LiveRamp's ATS, or Authenticated Traffic Solutions business, actually enables that connection in a cookieless world. So it actually will benefit. I don't think the market understands that. So they are growing. They do roughly $500 million in revenue. When you think of the business today, it's roughly $2.5 billion enterprise value. And this year will be the slowest growth for them. They're going to grow at mid-teens. I expect them to start growing the 20% plus next year. It's going to be one of those ones, Lisa, that goes through this period of adjustment. But I think over the longer term, it's going to be bigger than we ever thought. But it's going to be it's roughly around 2.5% today in terms of sizing. Happy with that until we get more confirmation that the thesis is proving out. But it's one of those ones. Both of them now become profitable. They're both growing. Their gross margins are 70% plus, so their incremental margins are running 40 to 50%. So both net cash balance sheets as well. We can see some good upside in both of those names, but it's kind of LiveRamp has been held back more by that shift in terms of the market sentiment. LivePerson, I think, has done relatively better because it's actually getting some of these big deals out there. The thesis will be LiveRamp will follow that over time as well.
Thanks, Bill. Another question for you on your barbell. Do you see opportunities to add to the growth side of the barbell, and how can we envisage that barbell looking in 12 months' time?
That's a hard one to answer. I think the growth side it just depends on the opportunities. We're looking at, you'll see next month a couple new positions, very small. As you know, I like to start small, build the position up as the business performs and as I get more conviction around it as well. They're in growth areas, more in the renewable space as well. They'll go into that growth barbell. So it's really where we find those opportunities at the end of the day. When you think of Cellnex, it was down to roughly 2% position, a couple months ago. But with the rights issue and through a weak period in the share price, we're able to take that up into the top 10 again. So that kind of goes to that trimming and adding bucket that we talked about. So the growth opportunity will just be about positions at the end of the day. If we see a lot of the names on the value side get very full, maybe that shifts more into the growth. But it really is, 12 months is a very hard time frame to call in this type of market, the way things are moving so quickly. We talked about the macro angle a couple webinars ago, how fast the macro is shifting. And it's really hard to call what that barbell will look like over the next 12 months. My gut feel, if you were to ask me today, and where I'm positioned, and I've said this before, I don't see the barbell shifting dramatically anytime soon, because I believe that we're going to see economic growth continue to surprise to the upside as those supply chains get replenished. And you really want to be exposed to that improving economy. If that 10-year starts to pick up as economic growth is solidified, I think you'll find higher PE stocks, more of those frothy stocks, potentially start to underperform again. They've had a bit of a renaissance in the past month or so as the 10 years come down. But there's a risk that as economic growth picks up again, you'll see that come down. So I'm actually shifting like you think about the growth barbell side, more on renewables, more on those longer term opportunities. So really hard to call, but I'll say I can't call 12 months, but I'll say over the next couple of months, I can't see that changing anything.
Thanks, Bill. This is a bit of a follow-up question, and you've kind of already touched on it. But if you believe that inflation is growing, how will the portfolio be changed?
Yeah. So this inflation discussion, there's still a lot of moving parts around it, but my gut feel is inflation goes through cyclical rebounds. We've seen that historically, but you have these major anchors that pushbacks on inflation, and that's debt. The amount of debt in the system, when you think about the government debt's never been higher. So they can't afford for too much inflation. They want that nice level, but they don't want too much. You have demographics, so aging populations push back on inflation. And technology. Technology is probably the biggest one. We're getting a lot of services for free. You think of your mobile phone, what you get today versus a few years ago, so that's quasi-deflationary in terms of services. Those three big, forces push against inflation. But you have these periods of cyclical rebounds, and that's what we're going through now. And that's a function of that pent-up demand and supply chain imbalance, effectively. So my thought around that was that we're going to get this higher level, maybe sustained for a little longer, but not run away. So if lumber prices, chemical prices, steel prices, freight, used cars continue to go, then yeah, you're going to have inflation continue to go on each other. But I believe that they're actually starting to peel over now. And we're going to cycle this next year. But on the back of that, you're going to have these supply chains need to be refilled. So you're going to have it probably sustained at a reasonable level longer than it might have done in the past, where it would have peeled off more quickly in terms of the inflation level. So I think you're going to have longer, and that, is that 6, 12 months? Hard to call, but probably around that level. And then we cycle all this and then we cycle this base effect of a higher level. So it's kind of hard to see how it grows on it. Like I mentioned, we really need to see that wage inflation really start to grow if you want that sustained level of inflation to come through. Now, how the business or how the portfolio benefits from that, you really got to boil it down to pricing. Does your business, firstly, get pricing power? Can they pass through all these inflationary pressures, firstly? And secondly, one thing I haven't talked about, and I think it's more important over the medium term, if you do believe it's a bit transitory, can they hold that pricing? And I'll give you a couple examples around that. So Tempur Sealy, they've raised prices to cover all inflation for this year. AZEK, which is composite decking, they've raised prices 3 times to cover all inflation this year. So the thing is, though, the average level of the pricing increase covers all the inflation for this year, yet from a time-weighted point of view, they're going to get more pricing next year because of the time that they put these prices through. So to get the price increase for next year, and if it is transitory and they can hold that pricing, then you're going to see some pretty strong abnormal profits come through. So I think that's the key thing to keep in mind. Transitory, sustained, take your view on that. But more importantly, look at your portfolio and can they pass those prices through and sustain those prices over the longer term. And I think that's more important than the discussion around transitory or sustained. And I believe our positions do have that capability.
Thanks, Bill. There are no further questions that have come through. So what I might do is just pass back to you for a final comment. If any questions do come in, I'll then ask you for your final comments.
Great. Thanks, Lee. I hope the overview was a little bit quicker. We had some feedback that the PTC one was just a bit too long. So I hope those stock overviews were a bit quicker and more succinct for you to run through what they are and what they do and why I'm excited about them. As I talked a little bit about inflation as well and how the portfolio is positioned, I feel it's pretty well positioned for that. One thing, though, I think if you know from my perspective, I like to have a balanced portfolio that's out there for all situations, and I think we do have that with the positions that we have out there. But I think the bigger takeaway from here is the disclosure, and I want people to know what we all own as shareholders, and that's why I want to put these portfolio holdings out there. I get feedback, why would you want to tell everybody what you own? I'm proud of them all, firstly, but secondly, some may just be coming into the portfolio, some might be being decreased in terms of size, so we're not disclosing the relative weightings. We do in the top 10, sure, but the size, we can trimming and adding to these positions. And I think one thing you'll see in the question earlier about turnover, a lot of the names here we've owned for a very long time, and I hope to own for a very long time. But we're in a really good position now where the portfolio is, relatively fairly fully invested. And any new position that comes in really has to fight its way in because we have some knowledge premium with a lot of these names, which a lot of them still have some pretty good upside in them as well. So I think from my perspective, transparency for me is big. And I guess from a takeaway perspective, I hope that's one of them you take away from this. And secondly, if you have any feedback, please just send it through. More than happy to change and adjust this webinar because it's for you guys to get the benefit from it. So I want to make sure the right message is out there, that you get everything you want out of it.
Alrighty, well, thank you, Bill. To all our participants, I trust you found today's webinar useful. A recording of the session will be sent through to everyone shortly, and we've also secured the date for our next Global Equity webinar, which will take place on Thursday, the 15th of July at 10 a.m. You can register to attend through the News and Insights section on our website, ellerstoncapital.com. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you all again for attending, and I trust you have a good rest of your day.
Great, thanks so much.